Introduction to net volume, a powerful indicator in technical analysis. Net volume measures the difference between buying and selling volume over a specific period. In the markets, we have buying volume shown in green and selling volume shown in red. Net volume is calculated by subtracting selling volume from buying volume, resulting in a single value that represents the volume imbalance. Net volume serves as a leading indicator, often signaling potential price movements before they occur. Positive net volume suggests bullish pressure, while negative net volume indicates bearish pressure. When net volume diverges from price action, it can predict potential trend reversals. Net volume is crucial in technical analysis as it reveals the true market sentiment behind price movements. It helps identify potential trend strength and sustainability, particularly during price consolidation periods. Net volume works best when used alongside other technical indicators for confirmation of trading signals. How net volume works. Net volume is calculated by subtracting selling volume from buying volume. Buying volume represents trades executed at the ask price, pushing prices up, while selling volume represents trades at the bid price, pushing prices down. When net volume is positive, it indicates stronger buying pressure, which is considered bullish. Conversely, negative net volume shows stronger selling pressure, which is bearish. Trading volume is classified as buying or selling based on whether transactions occur at the bid or ask price. Trades executed at the ask price are considered buying volume, as buyers are willing to pay the higher ask price to acquire shares. Conversely, trades at the bid price are considered selling volume, as sellers are accepting the lower bid price to sell their shares. Now let's see how net volume changes can precede price movements, demonstrating the cause-effect relationship. Here we can see a series of net volume bars with positive values in green and negative values in red. When we overlay the price line in gold, we can observe how price typically follows the direction indicated by net volume. Notice how strong positive net volume often precedes upward price movements, while negative volume can signal downward price pressure. In this section, we'll compare net volume to regular volume indicators and explain why the distinction is so important for traders. Regular volume only shows the total number of shares traded in a given period. It's a one-dimensional metric that doesn't distinguish between buying and selling pressure. Net volume, on the other hand, provides directional information by separating buying volume from selling volume. This reveals the underlying pressure behind price movements. This distinction matters because two trading sessions with identical regular volume can have completely different net volume profiles. For example, the buying and selling imbalance reveals hidden market sentiment and can help identify potential price reversals or continuations. Notice how, even though the total volume may be the same in both charts, the net volume chart reveals whether buying or selling pressure was dominant. Net volume charts combine price data with volume information to provide deeper market insights. Let's examine how to identify divergences between price and net volume. A bearish divergence occurs when price continues upward, but net volume starts to decline. This signals a potential reversal. Next, let's look at accumulation patterns. Here we see positive net volume without a significant price increase. Distribution patterns show the opposite. Negative net volume without a significant price decrease. This suggests selling pressure building up. Finally, sustained positive or negative net volume can confirm trend strength or weakness. Here, consistent positive net volume confirms an uptrend. In summary, net volume charts help identify divergences, accumulation, distribution, and trend confirmation, all valuable insights for better trading decisions. The net volume oscillator is an important technical indicator for analyzing volume dynamics. The oscillator plots net volume data as a line that fluctuates above and below a zero line. When the oscillator is above zero, it indicates net buying pressure in the market. Conversely, readings below zero show net selling pressure. Traders use extreme oscillator readings to identify overbought and oversold conditions. These often precede market reversals. Zero-line crossovers are important trading signals. When the oscillator crosses above zero, it can generate a buy signal. Conversely, crossing below zero may indicate a sell signal. Let's look at a practical trading example to see how the net volume oscillator generates trading signals. Notice how crossovers align with significant price movements. To summarize, the net volume oscillator is a powerful tool that measures buying versus selling pressure. Zero-line crossovers generate potential trade signals, while extreme readings can indicate market reversals. Always confirm these signals with price action for best results. Cumulative net volume is the running total of net volume over time. To calculate cumulative net volume, we take individual net volume values from each time period. We then add each new net volume value to the running total, creating the cumulative net volume line. Cumulative net volume can identify underlying trends that may not be obvious in price action alone. Divergences between cumulative net volume and price can signal major trend changes. Cumulative net volume can help spot institutional activity. When price consolidates but CNV rises steadily, it often indicates institutional accumulation before a breakout. In summary, cumulative net volume provides a powerful lens to view the underlying buying and selling pressure in the market, often revealing hidden trends and institutional activity. Net volume can provide different insights depending on the specific market conditions. Understanding these differences is key to properly interpreting the signals. Let's first examine how net volume behaves in trending versus ranging markets. In a trending market, net volume typically confirms the direction of the trend. Strong uptrends show persistent positive net volume, while downtrends display consistent negative readings. In contrast, ranging markets show net volume oscillating around zero with no clear direction. The fluctuations correspond to the price movements within the range. Market volatility also significantly impacts how we interpret net volume signals. During high volatility periods, net volume readings tend to be extreme, with larger swings in both directions. These signals can be more dramatic, but may also generate more false signals. Low volatility periods display much smaller net volume fluctuations. Here, even modest changes in net volume can be significant, requiring closer attention to smaller movements. Net volume is particularly valuable for detecting fake breakouts and market manipulation. A classic example is when price breaks above resistance, appearing to start a new uptrend, but net volume remains negative or fails to confirm the move. This divergence often signals a fake breakout that will likely fail. Let's review some guidelines for when net volume signals are most reliable. Net volume is most reliable during strong trends when it confirms the price direction. Be cautious in choppy markets where signals may be inconsistent. For best results, wait for confirmation across multiple timeframes. And remember that divergent signals are particularly powerful at key support and resistance levels. Combining net volume with other technical indicators can significantly enhance your trading analysis. Net volume becomes much more powerful when combined with other technical analysis tools. Let's explore the most effective combinations. Price patterns like support and resistance become much more significant when confirmed by net volume. When price approaches a resistance level with declining net volume, it suggests the upward momentum is weakening. Look for decreasing net volume when price tests support or resistance, and increasing net volume during breakouts for the most reliable signals. Moving averages combined with net volume provide stronger trend change signals. When price crosses above a moving average and net volume becomes increasingly positive, it strongly confirms a bullish trend change. Monitor net volume before and after moving average crossovers. The 50 and 200-day moving averages, when combined with net volume, provide excellent trend confirmation. Oscillators like RSI and MACD become more reliable when confirmed by net volume. Here we see a bearish divergence between price and RSI, where price makes a higher high, but RSI makes a lower high. Net volume confirms this divergence by showing decreasing and then negative volume, making this a much stronger sell signal. Let's build a practical framework for incorporating net volume into a complete trading system. This four-step approach ensures net volume is properly integrated with other technical indicators for the most reliable signals. Here's a signal strength matrix showing how net volume combined with price patterns and secondary indicators produces different levels of trading signals. To summarize what we've learned about combining net volume with other indicators, by using net volume as a foundation and adding other technical tools, you can build a comprehensive and reliable trading system. Section 10. Common mistakes and best practices when using net volume. Let's first examine common mistakes traders make when interpreting net volume signals. First, overtrading based solely on short-term net volume spikes without confirmation. Second, using net volume in isolation, ignoring price action and chart patterns. Third, applying the same interpretation standards across different market capitalizations. Fourth, ignoring broader market context that may explain volume patterns. Finally, making impulsive decisions based on single-day net volume signals. Now let's explore best practices for effectively using net volume in your trading. Always confirm net volume signals with corresponding price action and chart patterns. Adjust your net volume interpretation based on the stock's market capitalization and typical volume characteristics. Use appropriate timeframes for your analysis: daily for short-term trades, weekly for swing trades. Always consider net volume in the context of broader market conditions. Combine net volume with other technical indicators for more reliable signals. Let's take a closer look at appropriate timeframes for net volume analysis. Daily net volume provides short-term trading signals but contains more noise and false signals. Weekly net volume helps confirm trends and reduces noise, making it ideal for swing trading. Monthly net volume reveals long-term institutional buying and selling patterns, useful for investment decisions. Finally, understanding context is crucial when interpreting net volume indicators. Net volume behaves differently in bull versus bear markets, requiring adjusted interpretation. Always compare a stock's net volume against its sector performance for relative strength, and interpret volume spikes in the context of recent news events that may explain unusual activity. By avoiding these common mistakes and following these best practices, you'll be able to use net volume more effectively in your trading decisions.